A recent decline in San Miguel Corporation shares in the fourth quarter of 2022 due to their purchase of $400 million worth of debt, the tender offer of securities listed in Singapore Exchange Securities Trading, which caused them to incur a loss and affect their overall financial performance, has incited the researchers' curiosity as to the real importance of establishing a balanced combination of debt and equity. The rationale of this study is to assess and determine the significant relationship between the capital structure and financial performance of the food and beverage industry in the Philippines. Figure 2 represents the debt-to-equity ratio of the F&B industry from 2018 to 2022. F&B industry throughout these 5 years has a good debt-to-equity ratio and is considered financially stable with a low-risk profile. In the year 2021, the debt-to-equity ratio was much lower than 1, which has a 0.946700 mean average. Hence, it implies that those companies' assets are financed mainly through equity and are generally less risky to invest in compared to other years. One of the companies with a good debt-to-equity ratio in 2021 is San Miguel, with a 0.6 ratio, having an equity amounting to 11,519,000,000 and 11,000 and a debt of 6,878,000,000. The company achieved a 61% improvement in interest expense and additional financing charges, primarily because of savings on loan repayments, as well as an 18% increase in interest income based on strategic money market placements. This company is one of the F&B industries that has the status of good returns and can be a profitable investment option. Figure 3 describes the debt-to-asset ratio of the F&B industry. As presented above, the year 2020 had the highest ratio with a 0.493800 mean average compared to the rest of the years. A higher debt-to-asset ratio indicates higher risk because of the reliance on creditors. Furthermore, one of the companies that had a high debt-to-asset ratio during 2020 is Maxwell's Group. From a ratio of 0.65 in 2019, it increased by 0.11 in 2020 with a 0.76 ratio. The sudden increase in the debt-to-asset ratio is because of the decrease in the company's total assets of 1,380,323 pesos, and the total liabilities increased by 752,407 compared to the previous years. One reason for the high debt-to-asset percentage in 2020 was mainly due to the COVID-19 pandemic, which most of the companies in the food and beverage industry were affected by. Despite the increase in the debt-to-asset ratio in 2020, it did not increase by greater than 1. As displayed in Figure 4, the representation of how the financial performance of the food and beverage industry is assessed in terms of growth. The graph shows that there is instability of growth from 2018 to 2022. In 2018, there is an average of negative 0.30330, and in 2019, it rose to 2.738300, which indicates that those companies had good performance and were profitable. This is mainly based on their increase in sales, revenue, earnings, and investments. But then, in the year 2020, the The growth ratio decreased to a mean average of 0.717500, and in 2021 shows recovery yet in the succeeding year. There is a negative growth ratio of negative 0.317900. Before the incredibly challenging year, which is 2020, companies like San Miguel Food and Beverage had a high net profit of $32,279,000,000 in 2019, but it dropped at $22,401,000,000 in 2020 due to the COVID-19 pandemic and to the economy's contraction and quarantine restrictions. Figure 5 is a representation of how the financial performance of the F&B industry is assessed in terms of profitability. 2020, with a 0.46 mean, is the most successful year, while 2022 has the lowest mean of 0.103. The reason behind the highest mean could be the gradual relaxation of COVID-19 restrictions, the reopening of other establishments, and with the rising of popularity of different food delivery apps. The profitability of Del Monte Pacific Group was fortunately shielded by the epidemic. Better pricing and volume led to a 100 basis point increase in gross margin, which reached 21.2%. Figure 6 shows the assessment of the food and beverage industry in terms of liquidity. As presented above, 2021 has the highest mean of 1.973800. By regularly comparing projected and actual cash flows and matching the maturity profile of financial assets and obligations, Century Pacific Food manages liquidity risk. In 2021, interest income from wage loans came to 1,376,753 pesos. This was a result of the good management of current assets and current liabilities that resulted in a trend percentage of 58.09% from 1.36 current ratio in 2020 and 2.15 in 2021. Illustrated in Figure 7 the assessment of the financial performance in terms of leverage. The year 2020 has the highest leverage with a 0.474200 mean average, indicating that the capitalization was mainly composed of debt financing, which is due to the COVID-19 outbreak. A highly leveraged company carries a high risk of insolvency. Central Azucarera de Tarlac is one of the companies that had an increase in total debt to capitalization in the year 2020. The company had a 0.61 ratio in 2020, which is much higher than the previous year's 0.31 and the preceding year's 0.48. The reason behind the sudden increase in leverage ratio is that the company obtained a high amount of debt during the year 2020, amounting to 5,358,317,951 pesos, which is much higher than the previous year's 1,824,061,574 pesos. Along with the increase in the company's debt is a decrease in its equity from 4,2,801,413 in 2019 to 3,440,941,573 pesos in 2020, resulting in a high leverage ratio. As shown in Figure 8, the assessment of financial performance in terms of activity, the year 2018 has the highest total assets turnover ratio of 1 mean average, which indicates that the F&B industry during the mention was more efficient at generating revenue from its assets. The Jollibee Foods Corporation is one of the companies that had a high total asset turnover ratio in 2018 of 1 compared to the preceding years of 2018 to 2020, with 0.89, 0.58, 0.68, and 0.84 respectively. The Jollibee Foods Corporation had total sales of 150,200,828 pesos and 150,512,878 pesos total assets, resulting in a 1 activity ratio. As seen in Table 1, the 5 variables of financial performance related to the debt-to-equity ratio show various relationships. As leverage linked to the debt-to-equity ratio show that it has a very high positive correlation. With this, the debt-to-equity ratio and leverage have a direct relationship, so whenever there is an increase in debt-to-equity, the other variable reacts the same way. However, when it comes to debt-to-equity ratio, as being associated with liquidity, has a moderate negative correlation. This indicates that when there is an increase in the debt-to-equity ratio, it will have an increase in the liquidity of the company, but the degree of changes is not the same. It implies that the more equity is used in the capital structure of the company, the lesser is the liquidity risk, while the more debt capital is used, the higher the risk. It indicates that the company could be at risk of a cash deficit due to its large external debt, including interest payments. Lastly, the growth, profitability, and activity with a p-value of 0.487, 0.380, and 0.670, respectively, as being linked to the debt-to-equity ratio have no significant correlation. It means that any changes in the debt-to-equity ratio have no impact on growth, profit, nor the asset efficiency of the company. Just like the 0.95 and 0.82 debt-to-equity ratio of Emperador for the year 2019 and 2020, respectively, which also resulted in a net profit margin of 0.13 and 0.16 in the same respective years. In these particular results, we may conclude that when debt-to-equity ratio decreases, profitability increases. However, compare the 2020 and 2021 debt-to-equity ratio of Emperador with 0.82 and 0.63 and the net profit margin of the exact years of 0.16 and 0.19, it is evident that both the sub-variables have different impacts. It is an indication that just like growth and activity, profitability also has no significant correlation with debt-to-equity ratio. In Table 2, it shows the relationships of debt-to-asset ratio and the 5 variables of financial performance. First is the very high positive correlation between the debt-to-asset ratio and leverage. It means that when F&B's combination of an asset increases, the value referring to its leverage also increases. Peter D. explains that one financial statistic that to determine how much debt is utilized to fund a company's operation is the debt-to-asset ratio. It is just one of many leverage ratios available for analyzing capital structure of a business. On the other hand, the result shows that the debt-to-asset ratio has a moderate negative correlation when compared to liquidity with less than 0.001 p-value and negative 0.558% R. It is a statement of how the debt ratio adversely affects the liquidity of F&B industry, like Jollibee Food Corporation, where they took initiatives to increase JFC's liquidity. 2020 capital expenditures were cut from 14.2 billion initially budgeted for the year to 5.9 billion. Because of this, they achieved a much higher current ratio of 1.36 in 2020 compared to 0.68 in 2019. That increase in liquidity was also due to a slight increase in debt-to-asset ratio from 0.72 in 2019 to 0.68 in the following year. Lastly, with a p-value of 0.498, which is greater than 0.05, the table indicates that the debt-to-asset ratio as being bumped to growth has no significant relationship. The same goes for profitability and activity with the p-values of 194 and 0.392. Respectively, it is evident that whatever the combination of debt and assets as an entity's capital structure, it would affect the growth, profit, nor the asset efficiency of the company. Based on the findings presented in the preceding pages, the following conclusions were drawn. Number 1. The capital structure of the food and beverage industry in terms of debt-to-equity ratio and debt-to-asset ratio has been at a good level during the 5 years considering the results were not meant to. Next, the financial performance of the food and beverage industry in terms of activity, ratio, and growth has risen and was efficient in the year 2018 and 2019 respectively. While the profitability was on top in the year 2020 despite the outbreak of COVID-19, with regard to liquidity and leverage ratio, the F&B industry had a larger proportion of existing assets that could be converted into cash in 2021 with fewer borrowings. Recommendations. In order to increase sales and generate more revenue, food and beverage companies have to maintain a sufficient level of assets so as to minimize the debt and other expenses incurred in financing their activities. Next one is food and beverage companies will monitor their interest charge, their payment terms, and other fees that can affect the borrowings of their liquidating assets and the risk of losing investors. Food and beverage companies may think of their own ideal mix of debt and equity financing that is applicable to their business, considering that there is no perfect standard capital structure. Last one is that the investors may consider investing in those F&B companies whose capital structure is below 1 and withdraw to those having 2 or more. They may also consider the current and avoid too much investment during a crisis like the pandemic.